Good afternoon and welcome to the Equifax Market Pulse webinar, where we're going to be talking to you about the Q3 2024 consumer credit trends. For those of you who haven't met me before, my name is Becky Oates. I'm the Vice President of Analytics here at Equifax, and I'm delighted to be joined today by Kathy Katsouleris, who's our Analytical Consulting Lead, and Swanma Pandey, who heads up our Insights team. Now, before we get started, I'm just going to hand over to Jordan, who's going to talk you through about the On24 platform. Jordan.
Thank you, Becky, and good afternoon, everyone. Thanks so much for joining us today. Each area within the On24 webinar platform is responsive, so you can maximize or minimize each widget or box on your screen based on your viewing needs. There is an Ask a Question widget underneath the media player, so feel free to enter any questions you may have, and we'll try to address them throughout the session today. In the event that there are too many questions to get through, we will reach out to you individually to follow up in the coming weeks. Today's presentation and a lot of great related content in English and French is available for download in the related content area. This session is being recorded and you will receive the on-demand link via email tomorrow. Some additional features you'll notice on the bottom of your screen are reactions so that you can let us know how we're doing, our survey, and contact us. Feel free to check any of these out and provide your feedback. We really appreciate it. Now, with that being said, let's get it started. Becky, back to you.
Thank you so much, Jordan. So as always, we're going to start with a bit of an update on what's happening with the economy here in Canada. So for those of you who do regularly attend our webinars, you'll know that population growth has been a real key talking point for some time. And it's really a key contributor to growth across many areas of the economy, especially GDP in recent years. Now in Q3, growth remains steady at a 3% year-on-year increase when we look at population. So that's just over 250,000 people more in the last quarter. Now, these are similar numbers to what we saw in Q2. So we are still seeing population growth despite the federal government planning to maybe pull back a little bit on their immigration numbers in the coming years. Now, we talked last quarter about some of the media coverage about recent concerns on newcomer unemployment, particularly across the younger demographics. And we've taken a bit of a deeper look into what those numbers are telling us in relation to newcomers, which we're going to share with you in a few slides' time. On the provincial side, we're still seeing net interprovincial migration fall in Ontario during 2024, as consumers really are looking for cheaper cost of living alternatives. And Alberta is continuing to pick up some of that movement, which you can see on that right-hand chart there. So if we switch and look at employment levels, the good news is that we are still seeing overall employment numbers rising, which is the grey line on that left-hand chart. The problem still remains, though, that the level of growth is actually around 1.5% compared to 12 months ago. But as we just saw on that prior slide, population growth is actually double that. So that's up 3% year on year. So what this means is that the overall employment ratio is actually still falling. So even though new employment volume is increasing, it's just not keeping up with the population increase that we've seen here in Canada. Now, if we take a bit of a switch and look at unemployment rate, which is the right-hand chart, and that orange line on that chart, we have been seeing that grow for some time, but there has been a bit of stabilization and leveling off in the last quarter, which that does sound like good news. But unfortunately, when we look at participation rates or the level of the population actually looking for or being active in employment, we see that that's been falling, and that's really starting to mask to an extent the depth of the unemployment level. Youth unemployment, which is individuals aged 15 to 24 years, that's been one we've seen a lot of growth in recent quarters. The good news is that unemployment volumes for this group did rise in October. That's the first time since April. However, overall employment rate is still low for that group. So what does all this mean? Well, it means that on the labour side, when we start to look at what's happening, we are starting to see some softening maybe from a business standpoint. We're seeing some softening in the economy still. And that is a bit of a key headwind as we look forward into 2025. In terms of looking at the inflation side of things, the inflation outlook does continue to improve. The latest figures showing that we're finally back to achieving that Bank of Canada 2% target rate. The key component driving that drop really is gasoline price, which fell 9% in the last quarter and is down 4% year on year. Now, that reduction in gasoline price is partly due to high storage levels and high production in Western Canada. So that's kind of helping to bring the actual prices down a little bit on the gasoline side. Housing costs are still driving inflation to a significant degree, though. So if we actually take the overall inflation numbers from Statistics Canada and we remove mortgage interest from that level, we're actually at 1.4% year on year, and it's only 0.9% if we remove all types of shelter costs altogether. So despite the interest rates coming down, as mortgages start to renew, they are still moving to higher payment levels than they actually were previously, and that's really why we're still seeing that continue to grow. If we take a look in terms of what's happening from an income and savings standpoint, we kind of see that current inflation rate is 18.4% higher than it was before the pandemic. But we've seen household income increase by a greater amount than inflation in that time period. So on the surface, consumers really should be in a good place. And if you combine that with inflation levels starting to stabilize, we kind of might assume that this is really good news for consumers right now. And it is, but it also isn't. The reality is that when we start to look at certain groups of consumers and split down into some of the subsets, we are still seeing some signs of deterioration. So, for example, if we look back to 12 months ago, we're seeing that third income quintile, which on the right-hand table, you can see that in the middle, they actually have a drop in their net savings per household. And it's quite likely that some of that is really coming from that group maybe having a higher percentage of homeowners and maybe being impacted to a degree by those higher interest rates when those mortgages are coming up for renewal and seeing those kind of payments increases. And that's really having a knock-on impact to the overall savings levels. If we start to extend this macro view a little bit wider and take a look at some of the global regions, we can see some trends emerging globally quite similar to Canada. So Canada has seen that GDP per capita falling year on year. Now, some of that's linked to population growth, but we're also seeing that similar trend in South America, in Australia, New Zealand, even in the UK. And that really is kind of like those signs that on a global level, there are multiple regions where we're seeing a little bit of slowdown in the economies. Inflation-wise, many of these countries during and post-COVID did see large increases in cost of living, and that led to increases in interest rates in order to try and curb that inflation level. Now, the good news is that in all of those regions, we are seeing that those interest rate rises are starting to have the desired effect. We're seeing inflation levels falling across many of those different countries. There's actually a bit of a risk now starting to come in that inflation can actually be going a little bit too far the other way. Which means for businesses and things, perhaps that slowdown is really going to start to have a bit of a knock-on effect. And as we start to look at unemployment level, which we have seen some increase in Canada, it's stabilized a little bit. We're seeing unemployment levels also rising in many other countries, such as the US, UK, Australia, India, compared to 12 months ago. So, there definitely are signs of renewed growth in many regions, but we certainly still have headwinds, not just here in Canada, but also at a global level. So in case you aren't aware, Equifax does issue global insights and trends on a regular basis. So if you ever are interested in what's happening globally, you can go on our website, equifax.ca, and there is access to those reports on there. But I did just want to share a couple of interesting insights which are coming out in our Q3 report. So in Australia, they're starting to see mortgage conversion rates falling. So this is the percentage of new mortgages that are opened after an inquiry. Now that drop potentially could be linked to the increases in macro stress, maybe some lender tightening, as well as maybe just increased competition as consumers really starting to look for the best deals. And then on the US side, they've been showing some insights into the K-shaped economy, which we are seeing here in Canada, and we'll kind of talk a bit more about that later on. And that's really coming in the US from kind of the changing levels of financial stress being more exaggerated for certain parts of the population, such as millennials. We're seeing younger urban families and non-mortgage holders seeing that kind of level of increased stress on the US side. So I guess, Kathy, given everything that's going on in the economy, maybe you could share your thoughts on what this might mean for 2025.
Yeah, thanks, Becky. So just to get started, in terms of sort of, what we just heard, obviously there's quite a few things that are impacting our economic landscape. But yeah, as we look ahead to 2025, there's really three key things to be looking out for. starting with obviously further rate cuts, that softer labor market that you mentioned, and continuation of the K-shaped recovery that you just talked about. So if I had to double click on each of these just really quickly, as inflation continues to come down to that 2% target rate that the Bank of Canada has set and prices stabilize, we're going to see some stimulation in the economy, which means, consumers are going to be more open to spend versus save, and it's going to lead to more growth opportunities in the market. But let's not forget about that unemployment rate that continues to climb back up, right? And this is really because the demand for labor has slowed down in comparison to having more people now look for jobs, right? You've got the immigration, you've got sort of, the youth entering the job market. So again, that's happening at a faster pace. So why does that matter? Because, well, higher employment rates really impact sort of the consumer's ability to make payments. And this is where you start to see things like missed payments and more severe delinquency. And lastly, that K-shaped recovery that you mentioned, right? As the economy continues to sort of bounce back from a downturn, we're going to see a split in terms of, some population segments are clearly going to get some relief, while others are really going to continue to struggle. So clearly next year, we've got a couple of great things on the horizon in terms of growth opportunities, but there's also some risk to be sort of mindful of. And we're going to go into more detail specific to each of the different industries a little later on in the hour. So on that note, I think let's just sort of go closer and deeper into what's been happening with regards to consumer credit trends.
Amazing. Thank you, Kathy. So as we start to look at what's been happening in Q3, a few call outs really. We are seeing some early signs of easing financial pressures for certain groups of consumers. And I would emphasize the early signs part of that. As Kathy just mentioned, we still have a lot of headwinds going into 2025. So it wouldn't take a lot for that to really revert quite quickly. A bit like the US, though, we do have that K-shaped economy to a degree. And so there are some groups like those that are new to Canada and new to credit that have seen some increased challenges. And again, we'll kind of go into a bit more detail on that. And we are seeing some renewed growth, which is the good news on products as the lower interest rates start to take effect. Now, at an overall level, consumer debt rose to $2.54 trillion in Q3, and that's driven primarily by a 5.1% year-on-year increase in non-mortgage debt. Now, mortgage debt itself is still climbing, but the pace is really lower than what we saw a few years ago. And again, that's really linked to those elevated interest rates. On the non-mortgage side, credit cards continue to be a major contributor to the balances rising. We're seeing above seasonal growth of 9.35% year on year. But what's really interesting for Q3 is we are finally seeing a renewed growth in the auto space as well. So during the third quarter, we saw balances rising almost 12%, and that's well above seasonal expectations. When we start to look at credit activity, the population growth we saw in 2021, 2022, and into 2023, that really continues to be one of the key drivers behind increases in credit usage. Now, we know that immigration growth has flattened, so it is slowing down, particularly in the last 12 months for new to Canada and that new to credit group. And we're also seeing a bit of slower take up in credit usage for that group very recently as well. But we've still got that continued increases in balances coming from some of that population that kind of perhaps entered the credit industry in those kind of few years post the pandemic. When we start to look at consumer level, missed payments on file, that's still rising with around 1.3 million consumers missing some type of credit payment on their file during the third quarter. So if you look at that chart on the left-hand side, that blue line is the percentage of non-mortgage holders missing a payment, and the orange line, mortgage holders. When we start to look at this consumer level, though, we are starting to see some of those early signs of maybe the positive impacts of inflation coming down, cost of living being a little bit lower, and interest rates lowering. So when you start to look at that right-hand table, this is showing year on year the shifts in missed payment levels. So we are still seeing missed payments rising, but we're starting to see that rise slow down. And that's what we're talking about when we say some positive signs that are coming through. So for example, when we look at Q1 of this year, consumers with a mortgage, we saw missed payments rising almost 12% compared to the year prior. And those without a mortgage, it was up 12.3%. When we look now for Q3, that change is now 9.5% for mortgage holders and 10.9% for non-mortgage. So yes, it is still going up, but it's slowing down. That kind of missed payment growth is finally starting to show that maybe we are kind of turning the corner a little bit. Now, one of the groups we've been mentioning is those new to Canada, new to credit population, and especially those that have been credit active for 12 to 36 months. Now, this is really that part of the population that entered Canada or started using credit during those years where we had peak immigration numbers, so 2021, 2022. If we start to look at the change in delinquency rate that we see for those consumers, we're seeing the movement is really well above the average increases across the population. We're seeing the dollar balances, amounts of credit where they're missing payments rising as well. So this group is still showing that kind of increased level of stress, and we're seeing kind of that have more of an impact on some of the delinquency numbers overall. When we start to look at a product level, missed payments, they unfortunately are still up almost everywhere. So the charts you'll see on the slide here, these are 90+ day dollar and volume missed payment rates. So the gray bar being the most recent quarter numbers, and then we kind of have the prior year and pre-COVID. Some of the good news is when we look at some of those products that are really more impacted by interest rate changes, so things like home equity lines of credit, they tend to have large balances, it tend to be variable rates. We are finally seeing a drop in those 90+ delinquency rates for those types of products. So, as those interest rates are coming down and potentially the monthly payments are starting to drop, we're seeing consumers starting to manage those payments a little bit better, and we're seeing improvements. Unfortunately, though, for other products, we are still seeing the kind of missed payment levels increasing. Auto loans in particular, that's now sitting well above 2019 levels for both balance and volume. But we're seeing that kind of increase as well on some of the lines of credit and credit card as well. And this continued rise in missed payments is starting to show in some of the credit scores as well. So when you look at that left-hand chart, this is the average credit score. This is one of Equifax's scores that we're looking at here. During the pandemic, we saw those average scores rising, mainly because there was a lot of reduction in missed payments from things like deferral programs. We saw consumers paying off more of their balances, and that kind of led to those average scores increasing. We are now seeing that come back down again. So we're currently sitting close to 2018, 2019 levels when we look at average score. And you can see this on the right-hand side as to what's actually happening. This is kind of the percentage of consumers where we see a 50-point or more change in score in the last 12 months. So, if you look kind of above kind of the gray bars where you see some orange, that's where it's a worsening position to where we were pre-pandemic. So we're seeing areas or provinces like Ontario, BC, Quebec, a little bit in Prince Edward as well. They are actually seeing more movement, more deterioration in their scores. And that's a common theme that we've seen for some time in terms of provinces that do have a little bit more stress creeping in there. And then finally, just looking at insolvency. So consumer proposals are still really coming out as the type of insolvency that really has been chosen by consumers right now. Bankruptcy levels that fell during the pandemic are still pretty flat. And we're seeing actually consumer proposals have stabilized a little bit in Q3. Unfortunately, though, when we look at the dollar amount on some of these insolvencies, that is still going up for most provinces. So we're seeing, for example, in Ontario, where there is an insolvency for a consumer, the total balance that they are going insolvent with is up 14% year on year. So, there is still some deterioration. Yes, the volumes might be slowing a little bit, but actually the dollar amount is certainly higher. So that's what's happening at a high level. Maybe we can take a quick pause and maybe go through some of the questions. I know some of you shared some questions in advance. So maybe we can go through a few of those. Swanima, do you want to?
Yep.
Start
we
off?
have a lot of questions.
Okay.
The first one, maybe Kathy can answer this. With the proposed tariffs on all Canadian goods and GST tax break, which will promote consumer spending, is it likely that inflationary pressures from these will mean a slower interest rate reduction from Bank of Canada, causing higher interest rates for longer time and likely consumer debt?
All right, a tough question, but a loaded question. So I'll do my best to answer. Yeah, so the GST for now, it's really it's going to have a short-term impact, right? And it's not really going to influence the Bank of Canada's thinking. But tariffs, on the other hand, right, that are being threatened by Mr. Trump, that is really what's really going to perhaps slow down the economy further and create the need for more interest rate cuts, right? And as inflation will be greater for the U.S. The biggest weight on the Bank of Canada decision is really sort of the dollar, right? For those that follow the dollar, it's not doing too well. And this is where, again, there's, with the dollar sort of dropping down to about 71 cents right now, it's that fine line in terms of, increasing that interest rate gap. It's actually going to push the dollar down further, right? So this is going to impact inflation. And it may be the reason why the Bank of Canada does, in fact, move more slower than hoped. So hopefully that answers the question.
Okay. So the next question is, how have consumer scores been changing over recent years?
Yeah, maybe I can take that one because it's a bit easier than Kathy's question. Yeah, I mean, I think as I just kind of covered in kind of one of the prior slides, average credit scores normally are fairly stable. And when we looked at that chart we saw during the pandemic, they rose 5 or 6 points, which is quite a substantial movement in credit score terms. I know we talked, I kind of shared before that was around delinquency rates and things. So we're really kind of back now to 2019 levels. But again, I think that bump that we saw during the pandemic is pretty unusual, and it was really just caused by those unusual circumstances that we had during that time.
There is a follow-up question. Sometimes we have seen large point differences between TransUnion and Equifax consumer credit score. What causes that?
Yeah, that is something we get asked quite a lot. I think it's important to remember that there are multiple scores that are out in the marketplace. We have multiple scores ourselves. TransUnion does, FICO does, lenders even create their own scores. So depending on the version, there might be different types of data that are included in the calculation of that score. So, for example, some of the Equifax older scores never included mortgage data originally, but now they do, and recent scores do. So as data data coverage changes, you might then get different data being used in scores, and that can create a bit of a difference. So there's different data. There's also different algorithms. Our algorithm will be different to a TransUnion. And as you develop new scores, you get what we call swap sets. And this is really just differences in how consumers rank across different scores. And those swap sets are actually really super important, because when you move to a new score and you want it to be more predictive, you have to have changes in score to enable there to be more predictive power coming from it. So I think the simple answer is they're just different scores. They're built differently. There might be different data. I mean, the vast majority of consumers are going to rank order very similar, but you can get differences between them. And that's really why, on occasion, you might see large point differences. It's just one of those factors that's impacting it.
Okay, let's do one last question. What is the trend in average consumer debt from pre-COVID to now?
Yeah, so I mean, I'll talk about non-mortgage debt, because mortgage debt, that just goes up generally. So if we look back to maybe pre-pandemic, so Q3 2019, average consumer non-mortgage debt was $21,822. That fell as low as $20,430. That was in Q1 of 2021, so in the middle of the pandemic. And then since then, it's really been steadily rising. So we're actually very similar to 2019 levels right now, around $21,800. So similar to where we were back in 2019.
Okay, thanks, Becky. Right. The next question is, which segments are growing the fastest? I think I can answer that in the next session.
Okay, fantastic. So maybe then let's move on. And do you want to maybe take over, Swanama, and talk to us a little bit about what's happening in the mortgage industry?
Yeah. Okay, let's kick things off with an overview of Canada's housing market at the end of Q3 2024. Home sales activity rose by 7.7% in October, reaching the highest level we have seen since April 2022. While the 50 basis points drop in interest rate was announced in the later half of October, it did play a role, but much of the increase stemmed from the surge in new listings in September. And average national sale prices have also increased by 6% year over year in October. Interestingly, housing prices in previously overheated markets have remained subdued, while provinces experiencing high interprovincial migration like Alberta and Atlantic provinces witnessed a much larger increase in house prices. Overall, the national sales to new listing ratio has tightened to 58%. The long-term average for this metric is 55%, which is considered a more balanced market. And these trends highlight a cautiously optimistic outlook for the housing market in the coming year. Let's see how this renewed activity has translated into mortgage originations. Overall, originations increased by 5.2% compared to the lows of 2023, again, showing a gradual recovery. However, they remain below the typical third quarter levels that we normally see. And challenges for first-time homebuyer persist as they represent a declining share of originations. However, there are only two provinces where we are seeing an increase in first-time homebuyer activity. So Alberta and Atlantic provinces continue to see higher activity levels among first-time homebuyers compared to other regions. So basically, housing market which did not experience the same level of inflation during the pandemic, as regions like Ontario and British Columbia are proving to be more appealing options for those entering the housing market for the first time. And many buyers could be postponing purchase, awaiting further rate drops. It is important to note that this data is still Q3 2024, and the full impact of the 50 basis point drop in interest rate on new originations is yet to materialize. The overall growth in new originations was primarily driven by mortgage renewals, which made up nearly 50% of all originations. There has also been an increase in consumers switching lenders at either renewal or refinancing to secure better deals to take advantage of the recent interest rate drops. This trend could gain momentum as homeowners look to optimize their financial situation, especially with the expectation of further rate reduction in the future. So let's drill down more into mortgage renewals. Renewals play a critical role, is going to play a critical role as we move into 2025, given rising payments and affordability pressures. A significant portion of mortgage renewals in 2024 saw an increase in monthly payments compared to 2019. And nearly 40% of renewals faced a higher payment this year, with nearly 15% of renewals seeing payment rise by more than $350 per month. The impact was particularly strong for Ontario and British Columbia, where high mortgage values amplify payment increases. And many borrowers are also extending their amortization term to manage payments. And despite the recent rate drops, many mortgages next year will be renewing at a much higher rate. So let's see how these pressures are reflected in the delinquency rates across Canada. So we got a lot of questions around mortgage delinquency and regional differences, particularly rural versus urban. I'll try to address them in this section. National delinquency rates return to 2019 level, but as you can see here, we see a lot of regional differences. For Ontario, delinquency levels have reached yet another peak. Missed payments are higher than pre-pandemic across all cities in Ontario, with Toronto and GTA areas showing the biggest increase in delinquencies. And for Ontario, the financial stress was not limited to urban areas. Rural areas were equally impacted. However, in British Columbia, delinquencies were driven by urban centers, particularly Vancouver, while rural regions remained below pre-pandemic. In Quebec, the delinquencies overall are much lower. But when we drill down into cities, we see that Montreal has exceeded the 2019 pandemic levels for delinquency, so showing some localized financial stress. For other provinces, mortgage missed payments continue to be lower than pre-pandemic, with rural markets benefiting from lower property prices and economic stability. Apart from regional differences, it is very important to understand where did the high-risk mortgages originate. So mortgages from 2021 and 2022 are at most risk, with variable rate borrowers struggling with payments after 12 to 24 months. Rising interest rates has disproportionately affected younger homeowners and first-time home buyers who bought their first home during the low interest rate periods of 2021 and 2022. So many borrowers are negative amortization, which make them particularly vulnerable, especially in high-value property areas. So recent rate cuts could provide relief to some of those borrowers, but the focus for new year is going to be on renewals of fixed-rate mortgages, especially originating from 2021, which could further put pressure on the delinquency rates. Now I'll hand it over to Kathy now to provide us with a 2025 outlook for the mortgage market.
Yeah, thanks, Purnima. So just quickly to recap your section for our audience, we've seen some recovery really in terms of new mortgages being opened, and we are seeing quite a bit of switching happening, at renewal time. And then in more expensive provinces like Ontario, BC, we see those higher payment shocks, which then sort of correlates to also seeing higher delinquency rates. So when we look ahead to 2025, we do expect that those interest rates are going to come down by another 100 basis points, which is going to continue to stimulate the housing market and those new mortgage originations. But we also have that large number of expected renewals in 25. And if we look at sort of the variance between, the rate from 4 years ago and what it's going to be next year, we're looking at about a 200 basis point difference, which is definitely going to mean some payment shocks for this cohort. And if we look at the right chart there, from a roll rate perspective, those that go from paying their mortgage on time to being 30 days past due, we see that things have slowed down, most likely, again, due to the relief of the interest rate cuts. But again, some caution, that size of the delta could impact those roll rates. So coming back to sort of, what to be mindful of right now. Want to make sure the slide changed. We do have a housing market that is really heating up, right? And it's due to the sort of the stimulation from those 3 interest rate cuts this year, and most likely another one next week, along with, again, more switching behavior from the uninsured consumers, especially now that OSFI has eliminated that stress test requirement when switching lenders, which, by the way, came into effect 2 weeks ago. And so from a renewal standpoint, we mentioned there's quite a bit that's up renewal, which equates to about 1.2 million fixed rate mortgages that are expected to renew next year. And again, although the interest rates are dropping, remember, it's that delta. That delta is what's going to be driving that payment shock for that consumer. Becky touched on sort of some global insights, and specific to the housing market, in the US and in the UK, things are starting to pick up there as well because of rate cuts. While in Australia, again, Becky mentioned this, but I'm just going to repeat it, we are seeing some mortgage conversion rates dropping year over year, again, which can be likely to more consumers shopping around for the best mortgage, or really lenders tightening up the acceptance criteria to mitigate any downstream delinquency. So given all this, if you've joined us before, the question that I like to ask is, if you're a lender in this space, what should you be thinking about? So out of the gate, I'm just going to throw it out there. Top of mind should be mortgage attrition risk, right? Again, simply because with the OSFI change, things have been ignited. Consumers that are going into renewal, they're going to be on the hunt for better deals, which means as a lender, are you aware of who that may be? Is the consumer now leveraging a broker to help them? Again, questions that you would want to know the answer to. So this is where, if you're a lender, using something like a mortgage prediction, mortgage attrition predictor score can be very beneficial in helping you really identify who's more likely to switch. And it allows you to proactively then engage with that customer. Or alternatively, making sure that you're using monitoring programs like a trigger solution that's going to help you identify, is there any early shopping or browsing taking place with or without a broker? Again, to help you prioritize who is at risk and get ahead of securing that customer versus having them go to the competition. Lastly, again, I don't want to dwell on this, but payment shocks. they're real. And they're real risk for many consumers renewing their mortgages. And again, this is where, as a lender, using tools like Equifax's risk capacity index that looks at the consumer's cash flow situation, it's going to help you understand, again, how much of a payment shock can this consumer sort of handle without creating a financial burden, and allows you to sort of, look at the terms or conditions of that renewal loan and try to make sort of things work so that, again, that consumer doesn't have that financial burden. So on that note, I'm going to just pause right there. And I think I'm going to hand it back to Swarnima so that we can tap into what's been happening with the credit card market.
Thanks, Kathy. Let's tap into the credit card market. So we have seen a lot of growth in the credit card market. Credit card origination surged in 2023 with over 6 million new accounts. It was mostly driven by Gen Z. Immigration and new to credit consumers were major drivers back in 2023. But 2024 has seen a slight slowdown. Lower than peak immigration numbers has contributed to lower share of new to credit consumers in card originations. But levels are still higher than what they were pre-pandemic. Average credit limit on new card has also declined, which could be a sign of cautious lending as missed payments across all credit products are rising. While new originations are slowing, the story behind balance and delinquency is a little more complex for credit cards. So let's first look at the balance level. Credit card balances have continued to rise despite fewer new originations. So with revolving and delinquent balances seeing the largest increases, 58% of credit card balance as of Q3 2024 was estimated to be revolving balance, while this was 55% last year. So we have seen a much bigger rise in revolving balance for credit cards. Subprime consumers are driving much of the balance growth, with a higher percentage either revolving with high average balances or missing payments altogether. So while credit card debts have been increasing, credit card spend levels have not increased by much. So there is a lot going on in the slide. So let me first start with addressing the credit card spend behavior. We have seen a lot of balance growth in credit card, but it is not necessarily being driven by high consumer spending. When adjusted for inflation, we actually see the average credit card spend per consumer is actually lower than past years. So consumers have pulled back on discretionary spending amidst economic pressures. The balance growth is driven by consumers not paying their balance in full. The right chart shows the percentage of consumers who pay their balance in full, so the transactors. The proportion of transactors have been declining ever since interest rates started climbing up. But with the first drop in rate in September, we see quarter-over-quarter increase in the level of transactor. While the increase is not much, but those with high HELOC balance have seen the most significant improvement in pay rates. So the early impact of drop in interest rate is visible for consumers who have high variable rate credit products. Despite slight improvement in average balance per revolver continues to rise. And average credit card balance of consumers who are actually not paying their balance in full is 11% higher than what it was in 2023. And even out of those revolvers, many have actually started to miss payments, pushing credit card delinquencies back to pre-pandemic levels. But just like in mortgages, we have seen regional differences persist. Delinquencies are again driven by Ontario and British Columbia, while the rest of the provinces, missed payments have not yet reached where they were back in 2019. Further, rural areas fare much better than urban regions, except for Ontario, where financial stress is across all regions. And again, vintage view of delinquency rates also show higher levels of financial stress from accounts opened in late 2021 and 2022. This was the time where we saw the average credit scores peak as a result of deferrals and payment benefit. So consumers who took credit during this time periods have been missing payments at a higher rate. And this trend is again consistent across all products. And with recent changes in economy, we do anticipate a lot of changes in the credit card market, which Kathy can take over now and share the outlook for 2025.
Yeah, no, thanks, Surnima. So yeah, as we look forward to 2025, right, we've heard that the government has actually slashed immigration by about 20%, which has been a key source of where new growth opportunities for the card market has come from, right? Followed with, we've seen a growing trend around multi-generational households. Which means, more younger people are having to stay at home longer because the cost of living and being independent and living on your own, that cost is very high. And as a result, this actually leads to delayed credit activity for this cohort. And lastly, again, chart to the right, roll rates, right? We do see some flatness, which could be misleading, given that over the last couple of years, we did see quite a bit of growth in cards being issued, new cards being issued. And so that balance in your base, which is used to calculate the rate, that's a lot bigger, but it gets muted by the actual number of balances that are actually experiencing stress and rolling into early stage delinquency. So coming back to sort of current and emerging trends for the cards market right now, for starters, do expect a more competitive landscape for growth opportunities. Again, we've got less immigration coming in to the country, which means it's going to be harder to grow or issue new cards. And with consumers being more conscious about spending, we do see some softness with regards to pulling back on that discretionary spend. But of course, when you've got some big events like the Eras Taylor Swift tour sweeping through Canada, and you've got the GST relief or some holiday shopping, some consumers may splurge a little bit more. When it comes to payment behaviors, again, because we've had some interest rate cuts, we have seen some pockets of consumers able to pay down or pay off their credit card and get some relief because perhaps they've had some other variable rate products that has allowed them to sort of, save on interest there and pay off the credit cards. But we've also seen pockets of consumers, as we heard, like the newcomers to Canada, who did go into quite a bit of debt when they landed in Canada over the last couple of years, right? Because they came in when the environment had higher inflation, and as a result, are struggling and experiencing financial stress in making those payments, and in fact are actually missing a lot more payments. So again, given these trends, if you're a lender in this space, what should you be thinking about and what should you be doing? So for starters, again, growing that base, it's going to be competitive. So making sure you've got optimal adjudication strategies. Where you do have consumers that are new to credit, like the new immigrants or the younger population, you want to ensure that you're not just relying on traditional credit information, but you're also looking at alternative data sources like foreign credit data. For example, Equifax being a global credit bureau, we've got the ability to pull in credit information from the newcomer's home country, which can then be used in the decisioning process. Or for younger Canadians, who are able to leave home and are able to move into their own apartment and pay rent, again, that data point can also be used in the decisioning process. Another key item, line assignment strategies, whether upfront in the application process or once the card is in the wallet, again, the credit limit can really influence a customer accepting a card offer or using that card from their wallet. And this is why incorporating, additional data points like the risk capacity index, right, where you look at the consumer's cash flow, it's going to help you optimize the line assignment that is offered and given to that consumer. And same thing goes with account management practices, continually monitoring your customer's financial position by getting refreshed data. Again, this is where you can get a lot of value by also looking at sort of the latest cash flow measure, again, to make sure you're mitigating any default risk, or again, you're leveraging it to understand, can I stimulate more usage? So let's put a pin into the cards talk and let's switch some gears, and I'll have you, Surnima, jump back into the driver's seat and talk to us about auto.
And I'm going to put a break on that, Kathy, and say, can we just do a quick question? So we do have a credit card specific question for you, Kathy, if that's okay. So the question that came in is, do the speakers see a movement away from credit cards to other forms of payments? What is the projected future of this trend and pace of change towards that? So I don't know, Kathy, if you've got any thoughts in terms of credit card usage, and there's a lot of different options out there.
Yeah, we do see some buy now, pay later data coming in, and it is pretty stable. And in fact, it's actually dropped a little bit since 2023. And because credit card usage is still so high, and although there are other payment options out there, we still see that the credit cards are still in high demand.
Okay, all right, fantastic. I'll take my foot off the brake. And Swanma, do you want to take a look at auto?
Thank you. Thank you for letting me drive this. Okay, so before we move on to the auto insights, I'll quickly explain how we divide the auto market. Auto lending is split into two segments: loans from dealership and then non-bank lenders, which we call captives, and then traditional bank auto loans. Let's look at new originations for auto. Auto has seen the strongest growth in credit lending. Both non-bank auto loans as well as leases have rebounded, and the growth was seen across all consumer segments. So we are seeing more auto loans come in, more auto leases come in. Loan amounts have also shown a drop for auto loans, while leasing amount continues to go up due to high new vehicle prices. Overall, captive loans gained market share in 2024, reflecting consumer preference for dealership financing. Bank loans, while still significant, are losing share, particularly in new car purchases, which we'll see in the next slide. Bank auto loans were marginally up from last year, driven mostly by used cars. Strong demand persists for used car due to, again, the affordability gap that we're seeing between the new and used vehicles. Therefore, from an affordability standpoint, used car loans are still more desirable than new cars for many consumers who are facing affordability challenges. And hence, we have not seen that surge in new car loan originations for quite some time. And with high auto demand, we are also seeing high fraudulent activity in auto lending. So fraud rates in auto loans have risen by over 54% year over year, and it was driven primarily by Ontario. First-party fraud is secured lending, so we mostly fraud in auto is usually first-party fraud because that's what we see in secured lending. And first-party fraud, like misreporting your income, employment, and financial details to get your loan approved, is formed majority of the auto fraud application fraud. And it's often the younger consumers with low credit score who are often involved in these cases, adding risk for the lender. Identity fraud, which is normally it doesn't happen for secure lending, it's usually very common with unsecured lending like credit cards, is now affecting auto lending as well, which was not the case before. So pre-pandemic, we did not see much of identity fraud in auto lending, but now we are seeing more and more identity fraud in auto lending. It's a big concern. It accounts for 18% of auto fraud cases, with high-value consumers being primary targets. So older consumers with strong credit scores are often the targets for these identity fraud. And with the rise in the amount of data available online, fraudsters are creating fictitious identity for those with good credit performance. So addressing auto fraud is getting very critical to ensure stable environment and to prevent losses. So let's examine more how the price trends have reshaped the loan structures. So high vehicle prices, drop in interest rates, and more vehicle availability is again starting to change the loan structure, especially for used cars. So we saw a shift in amortization term for used cars when the prices were up and interest rates skyrocketed. Consumers were opting for longer loan terms to manage payment. With current rate drops and normalizing of used car prices, that rise in long-term loans is starting to actually slow down. New car loans have not seen a similar shift in terms. However, average interest rate for new car loans has seen a significant drop. So now we are seeing more offers and better deals for new car loans that are emerging, which stopped after the pandemic, and this could boost demand for new cars. Let's look at auto loan delinquencies. Again, we got a lot of questions on auto loan delinquencies. They peaked in 2024, as you can see from the chart, and marking the fastest increase in missed payments across all credit products. And used car loan continue to see rising delinquency. And again, I think the affordability challenge and higher loan amounts are still impacting used car loans, because the monthly payments, average monthly payment for used car loans in 2024 is much higher than what it was pre-pandemic. So new car loans missed payments remain above pre-pandemic levels, but it has not risen as quickly as the used car loans. Though the increases are much slower than used cars and even non-captive auto loan lending. Again, looking regionally, both rural and urban areas are seeing higher delinquency rates. So unlike other products, auto delinquency rates are higher across all provinces or regions. There's not much regional discrepancy in Q3 2024. And non-bank auto loans delinquencies have slowed down from the peak, but bank-originated loans have continued to see higher financial stress. Now, again, we are going to look at the vintage delinquency curve to see which are the high-risk loans. So again, the loans that originated during the low-interest time period, 2021, 2022, are driving higher missed payments now, reflecting the borrower vulnerability. We are seeing a slowdown in early payouts. So if you look at the chart on the right side, that's an early payout curve. It shows all the auto loans that were opened in 2019, how many of them paid before the amortization term was over. So for 2019, it was much lower, but as the interest rate started to drop in 2020, we started seeing higher pay downs for auto, because lower interest rate gives you refinancing opportunities, a higher disposable income. So a lot of that contributed to that increase in auto early payout curves. But now that the interest rate started going up from 2022, the auto payout curves have also slowed down. But there is still an opportunity. If the rates drop further, we might see that auto early payouts curve start to increase again. So I'll hand over to Kathy again for our 2025 outlook.
Yeah, so clearly we've got some good news happening here in the auto market, right? Which is primarily being fueled again by the lower used car prices as well as the better interest rates. And we heard there's been a comeback in seeing more subvented loans, where again, for those that don't know, it's where the manufacturers subsidize the cost of the loans, and you see those 0% or very low rate offers on new cars. But we also heard some not so good news with regards to fraud really hitting this industry, and of course delinquencies back up. So yeah, as we look ahead to 25, obviously we've got, we've mentioned it a couple of times, there's some growing concerns with regards to Trump threatening that 25% tariff on all Canadian goods entering the US, and that includes auto parts, right, and raw materials that normally go back and forth over the border before the vehicle's actually done and completed and ready to be sold. And what that would mean is like more expensive parts could slow things down in terms of production. It could lead to supply shortage. And of course, if you've got smaller supply, guess what? Those prices go back up and it makes it more expensive to buy a vehicle. So not a good scenario. On a different note, right, we've got the interest rate cuts are bringing relief to consumers. And again, those that are sort of have, stronger credit worthy sort of profiles. Again, Swarnima mentioned early payout, right? We can see a lot more sort of takeoff in terms of customers taking that option. And again, from a roll rate perspective, we do see that things have dropped, but they are actually high. So coming back to sort of, current trends right now to sort of be mindful of, yes, there's growing demand in the market, which is really stimulating good growth. But again, we've got the headwinds from the US tariffs that could hamper things. From a financial stress position, again, we continue to see a trend on missed payments and delinquency coming from sort of the newer vintages. And of course, fraud, right? Fraud is rising sharply for this industry. And a lot of it has to do with third-party identity theft, where, older consumers are being sort of victimized with sort of their information being used for applications. So again, if you're a lender in this space, really quickly, what should you be thinking about? Well, out of the gate, I'm just going to start with fraud, right? Make sure you've got a solid fraud detection solution in place. Those that are in the fraud world, they know there's no such thing as a silver bullet. Fighting fraud means layering in, different fraud tools and making sure that they're solid. For example, a lot of lenders leverage Equifax's fraud consortium platform, which is the only one in Canada, might I add, where you're able to screen applicant information against known reported fraud data. And then leverage advanced analytics and AI capabilities through that platform to really hone in on highly suspicious applications, look for trends, or really connect the dots with regards to, is it a fraud ring? Additionally, verification, right? Another important factor, mitigating fraud, making sure that those ID documents that are presented during the application process, they're valid, they're real, they belong to the consumer that's presenting them. And again, Equifax here, we do have an array of such identity management solutions that can definitely help lenders. Next up, we mentioned delinquency on the rise, newer vintages. Again, this is where, things like leveraging cash flow information at the time of adjudication can really sort of support understanding whether or not that customer might sort of end up defaulting early. And this is the same thing goes with making sure that once the loan is booked and it's on the books, are you getting refreshes on an ongoing basis, because a consumer's financial position can change at any point. So making sure you've got the latest, greatest credit data, it can help you really mitigate the scenario and minimize your losses. And lastly, early payouts, we mentioned them, they're on the rise in terms of consumers really sort of leveraging that. And if you are a lender, you got to be sort of aware that the last thing you want is a mass exodus of all the good customers in your book leaving you. And what you're left with is sort of your more riskier customers. So this is where you want to get ahead, right? If there is somebody that may sort of, seek an early pay, like, can you sort of, rejig and do a new loan, a lower interest rate to keep that customer in your profile or in your book. So on that note, I know we're running out of time. So Becky, you're back in the driver's seat. Take it home with some questions.
So we've had a lot of questions. I'm going to try and just fly through a couple. How do we get a credit report from out of Canada, for example, Mexico? So our global credit file solution that's launched with India, we have, I think, 18 countries as a fast follow. If you are interested in finding out more about that solution, when you do the survey at the end, I think you can put some comments in there in terms of you would like someone to reach out to you, do that, and we can kind of get in touch and talk to you about how you can get that. There's been a few questions around negative equity from the mortgage side and into new loans and rolling over negative equity into new loans. That isn't something we've done a deep dive into, but my promise is we will take a look and see, can we figure out from our data any information on that for next time. There's been a couple of comments in terms of wage growth. So a lot of questions around wage growth. Is it slowing in Canada? What's the impact that might have on the workforce and into kind of credit payments? What I can tell you is that we actually do have a business credit trends and panel discussion coming up on December 12th. So same time next week. We've got a great series of people from Equifax who are going to be talking at that. So if you are interested in finding out more about what's happening on the small business side, talking about things like wage growth and some of the impact that might be having, I would highly recommend joining that webinar. Because there will be some good information. We also recently launched, in conjunction with BDC, a new commercial health index, and one of the component parts in there does look at things like wage growth as well. So tracking that might be a useful thing to do. Apart from that, I know we're out of time. There was a lot of questions. We will try and reply to as many of you as we can post the session. Please do fill out the survey afterwards. And if you're going to join us in Q1 for our Q4 webinar, please do send us pre-questions. We will try and make sure that we have some great answers in advance if you kind of fill those in and let us know what you want to know about. Apart from that, thank you so much on behalf of Kathy, Swadham and myself, and hopefully we will see you in the new year.